My name is Kim Heng and I will be your host for today's webinar. I'm a partner in our Department of Professional Practice. It's a group that helps clients and KPMG staff with interpreting and applying IFRSs and other financial reporting requirements in both the for-profit and not-for-profit sectors. Joining me on this webinar today is Ben Sumahu, a Director, and Julie Locke and Joe Rinarelli, Senior Managers within the firm. The accounting for revenue and income is set to change for not-for-profit entities. The types of revenue and income streams that are likely to be impacted are varied and include any of those streams listed on this slide, and many that are likely to appear in your financial statements. While the for-profit sector is already busy applying the new revenue standard, AASB 15, Revenue from Contracts with Customers, this revenue standard and the new not-for-profit income standard, AASB 1058, become effective for the not-for-profit sector from 1 January 2019. In helping our clients through the implementation journey, our experience has been that closer consideration of contracts and other documentation to obtain a sound understanding of the specific facts and circumstances of the arrangement is raising a number of implementation issues in applying the new requirements. Further, the AASB is not done with providing guidance for not-for-profit revenue and income issues. For example, the AASB has recently issued implementation guidance for not-for-profit public sector licensors as an appendix to the new revenue standard. In addition, the AASB has issued the first in anticipated ongoing series of FAQs for not-for-profit entities to help in applying the new standards and implementation guidance. Furthermore, only last week, the AASB decided to issue an exposure draft proposing a temporary option for not-for-profit lessees to not initially fair value a right-of-use asset arising from leases that have significantly below market terms. When the new income and new leases standard becomes effective, we will discuss this later in our webinar. In our last webinar on the topic in February 2017, we stepped through the requirements of the new income standard in some detail. We will not be stepping through the detail again today. Rather, we will be looking at implementation issues that we have helped our clients work through since the guidance was issued. Another observation before we look at our agenda for today. Application of the new revenue and income guidance to not-for-profit transactions will not be straightforward. Judgment will be required and interpretation of the standard is still evolving. Therefore, in some of the examples we will discuss in our webinar today, we have clear views on how we believe the guidance will be applied. But in other examples, we have provided some indicative views that will need to be further refined with consultation with the sector and possibly the Accounting Standards Board. We have identified these areas as a watch this space. With that introduction, let's look at our agenda for today's webinar. In today's webinar, Julie will look at when to apply which standard, stepping through a useful decision tree to help guide considerations. Ben and Joe will discuss questions and implementation issues that we are seeing in practice. They will focus on the criteria that needs to be assessed, whether income is recognised immediately, over time, or a point in time, and the interaction of the revenue and income guidance with the new leases standard, AASB 16, and the new financial instrument standard, AASB 9. Julie will then return to highlight transition considerations and disclosures.
Thanks, Kim. We find that the first question an entity often asks is, when do I apply which standard? And how do the revenue standard, AASB 15, and the income standard, AASB 1058, interact with one another? As Kim mentioned, we've put a decision tree together, which we think helps in determining which guidance needs to be applied. So as we step through, you will see that there are quite a lot of words used on the slide, so I will summarise to illustrate the relevant considerations. For a not-for-profit entity, the first question will be whether you have received a service that is being provided by a volunteer. This could be a volunteer working in a charity shop or an accountant providing bookkeeping services for no fee, for example. If the answer is yes, then you'll go straight to the guidance in the income standard. If not a volunteer service, then you would think, have you received cash, goods, the right to use property or another asset for which you have paid or provided consideration significantly less than what an entity in the market would have paid? And this asset enables you to further your objectives. This would include receiving cash to construct or acquire a building where you will control the building. That is, that you will not need to hand it back or transfer it to a third party. If the answer to all of this is yes, once again, you'll go straight to the guidance in the income standard. If, however, the answer was no, you look at questions that could pull the transaction into the revenue standard. Firstly, is there an agreement such that the customer can enforce their rights? If yes to this, then you would ask if the promise in the agreement is sufficiently specific so that you can determine when the performance obligation, what is being promised in the agreement, is met. Ben and Joe will discuss the judgments around these two questions shortly. If the answer is no to either of these questions, once again, you would look to the guidance in the income standard. Where you are able to answer yes to those previous two questions, the transaction will be recognised in accordance with the requirements of the revenue standard, except to the extent that there is a material donation element to the contract. This might occur, for example, where a fundraising dinner is held and there is the provision of a meal as well as a donation as part of the ticket price. When there is material donation element, then the transaction will need to be disaggregated into elements accounted for under the new revenue standard and the residual accounted for under the income guidance. So this slide shows you how to apply the not-for-profit income standard. And it may be familiar if you attended our previous webinar. You can see from the second box that it tells you how to pick up the debit side of the transaction. And moving down the flowchart, you then need to assess whether there are any credits you need to recognise in relation to the transaction, such as a lease liability or a financial liability. And Ben and Joe will discuss an example of each of these types of so-called related amounts that may need to be recognised as a credit in a transaction. It is any difference between what you recognise as an asset and the related credit amount that determines the amount of income that is recognised immediately. So with the first decision tree and this flowchart in mind, I will now hand you over to Ben.
Thanks, Julie, for the introduction and really setting a good framework of how the new standards interact with the not-for-profits standards guidance. This next section, we're going to be focusing on the implementation challenges that we've seen in practice. And where we've seen a lot of these issues have arisen is determining whether or not a particular arrangement is in the context of AASB 15, the revenue standard, or AASB 1058, looking whether it's a contribution. As well as looking at those differences, we're also going to look at some examples around the implementation of the new leases standard and how that interacts with the not-for-profit standard and also the financial instrument standard. So let's start with the interaction with the new revenue standard. Now, for those of you who have attended our previous revenue step webinars, you're probably familiar with the five-step process. The revenue, in addition to the revenue standard, there's also some specific not-for-profit implementation guidance that's been issued that explains how not-for-profit entities apply the five-step model. In looking through some of the implementation issues that we've seen with clients and others, what we're going to focus on primarily is step 1 and 2. As Julie mentioned earlier, these are the key steps in terms of identifying whether an arrangement is within the scope of 15 from a not-for-profit perspective, as well as the key step 5 in terms of when you recognise revenue. So I'll be taking you through the identifying the contract with customers, and Joe will be taking you through the sufficiently specific performance obligation. So how does contract enforceability differ for a not-for-profit from a for-profit in terms of AASB 15? Let's go through some of the specific guidance that the AASB has issued. Well, in identifying whether or not you have a contract with customer, important thing to note is that in a for-profit context, you might think that the recipient of the goods or service would be the person you have a contract with. The not-for-profit guidance clarifies that a customer doesn't need to receive the goods or services. For example, a government who directs goods or services to be provided to the community could also be a customer. Secondly, how do you translate substance in a not-for-profit context? A contract doesn't need to have commercial substance, only economic substance. What does that mean in practice? That means that, for example, that contracts to provide goods or services may be on a subsidised or cost recovery basis, rather than what we might think of from a for-profit entity in terms of receiving fair value for performance or service. Finally, when an agreement is enforceable depends on whether it's enforceable through legal or equivalent means, and the performance obligation is sufficiently specific, which Joe will cover later. An example of an enforceable agreement would include where a refund in cash or kind is required when the specific performance has not occurred. A refund right is not always required. For example, when the customer has a right to enforce specific performance or claim damages for non-performance. So let's go through an example to illustrate some of these principles. So we have Clean Water, who is a not-for-profit, non-government organisation, NGO, that specialises in assisting governments with implementing water purification projects. Clean Water enters into a Memorandum of Understanding, an MOU, with the government to manage its clean water projects. The MOU outlines various activities for which Clean Water will be responsible for. The government will partially fund the cost of the project. It's important to note that the MOU specifies that it's not legally binding, does not impose a refund obligation on Clean Water, or refer to other enforceability mechanism. So how do we account for this as a not-for-profit? Well, let's walk through the considerations that we need to make. First of all, is there a customer? Yes, we would say there is a customer. Provisions of services to a third party, as we mentioned, being the communities, rather than directly to the government signing the MOU, does not stop there being a customer. But is there economic substance to the arrangement? Well, yes, there is economic substance. Although it doesn't cover the cost of performing the activities, which commercially would apply in a for-profit context, contracts to provide goods or services to members of the community, in this case Clean Water, may be on a subsidised or cost recovery basis for not-for-profits to have economic substance. But is the MOU enforceable? Well, the answer is no. The agreement is not enforceable. There's no enforceable mechanism, and absent any other information here, there's no stated intention to rely on the MOU. Let's change the fact pattern slightly just to provide some extra context. We now have some additional information that the parties indicated in their discussion that they intended to rely upon the MOU. Clean Water commenced providing services under the MOU and has already reported for around 2 months. So does that change the outcome? Well, why don't we take a poll question. Let's work through what we think the implementation guidance would point us towards in terms of this fact pattern. Well, the conclusions in relation to whether a customer exists and there's economic substance haven't changed. But what about the parties' intentions and services performed? Should that impact whether there is a contract? Well, the answer is yes. Given the intention of the parties to rely upon the MOU and the actions of Clean Water in reliance on the MOU is considered to be enforceable following the implementation guidance, despite the statement that it's not legally binding and the absence of a refund obligation or other enforcement requirements. It's considered enforceable by other equivalent means for not-for-profits. Now, in practice, we imagine this assessment of intention will require some judgment. Let's now go to the second step of the revenue standard, the performance obligations, which I'll pass it over to Joe.
Thanks, Ben. Let's now turn our attention to Step 2, determining whether performance obligations are sufficiently specific. As a reminder, under AASB 15, Step 2 of the model requires the identification of distinct promises in a contract. This consists of assessing whether each of the promises in the contract are capable of being distinct and whether the promises are distinct within the context of the contract. We've explained the requirements of AASB 15 in detail as they apply to for-profit entities in previous webinars, which are available on our website, and won't go over these today. Rather, we will focus on the not-for-profit specific guidance on this step. So let's have a look at that. As the transfer of goods or services can be quite different in a not-for-profit entity compared to for-profit entities, the standard requires performance obligations to be sufficiently specific to be able to determine when the obligation is satisfied. Key considerations to determine whether performance obligations are sufficiently specific are: the activities being performed by a not-for-profit need to be a transfer of goods or services to the customer. Unspecified goods or services provided over a particular period may not in themselves be sufficiently specific. And an acquittal process can demonstrate delivery of goods or services. Further, the implementation guidance of the standard provides factors in a contract that may indicate performance obligations are sufficiently specific and include the nature or type of the goods or services, the cost or the value of the goods or services, the quantity of the goods or services, and the period over which the goods or services must be transferred. Considering this guidance, let's look at an example to understand the key factors. Assume a research organisation is given $5.2 million in cash to conduct research. The key terms in the agreement include provide research in a specified area, in this example food production and climate, return all unspent, uncommitted funding on the completion of the research, all research remains the property of the research organisation, and the agreement is enforceable. Based on the fact pattern, are the performance obligations in the contract sufficiently specific? As we can see, the arrangement requires the entity to develop research in a specified area and does not require the entity to transfer the non-financial asset back to the transferor or to another party. Nor does it require any form of output, for example, making the research findings available. Based on this, the contract does not appear to require the transfer of goods or services to a customer. That is, there is no specific outcome provided for the cash receipt. Therefore, this arrangement is not sufficiently specific. Kim, can you take us through a variation of the fact pattern?
Sure, Joe. So let's change the fact pattern slightly so that all intellectual property now needs to be provided to the government, and the research organisation is required to publish their findings in a scientific journal within 5 years. Now that the IP needs to be provided to the government, then there is a transfer of a good or service. Let's then see if this need to transfer a good or service is sufficiently specific based on the factors provided in the guidance. Participants on today's call will recall that specifying in the contract the nature or type of the goods or services, the quantity of goods or services, and the period over which those goods or services are provided are key factors that indicate performance obligations in the contract are sufficiently specific. Therefore, in this amended fact pattern, we believe that the performance obligations in the contract are now sufficiently specific as research organisation now needs to conduct research into food production and climate and produce a report, so therefore the nature and quantum of the services is clear, and they need to do this within 5 years. So this is the period over which goods or services must be transferred. So in this example, we think that the contract is enforceable and the performance obligations are sufficiently specific, and the arrangement would be accounted for within the scope of AASB 15.
Thanks, Kim. Let's look at an additional example to understand the factors in more detail. Assume a childcare organisation is given $10 million cash to provide childcare services. The key terms include provide childcare services to low-income families, return all unspent funds after 2 years, and the agreement is enforceable. Based on the fact pattern, is this contract considered sufficiently specific? I'll now push out a poll asking whether you think this contract is sufficiently specific. Although the agreement is enforceable, the terms are written such that it is unlikely to be sufficiently specific, as there are no description of the types of services to be provided, nor the quantity of services. If you recall from the previous slide, we said that the unspecified goods or services over a particular period are not in themselves sufficiently specific. Kim, can you take us through a variation of this fact pattern?
Okay, so once again, let's change the contract slightly such that it now indicates that the childcare organisation needs to provide childcare services consisting of 250,000 hours of care in 25 childcare centres to children aged between 1 and 4 from low-income families, and that's defined in the contract. With this change, in fact, you can see that we have now met most of the sufficiently specific factors that we can see on the screen. Accordingly, in our view, the change fact pattern results in the performance obligation in this contract now being sufficiently specific, and this contract would be accounted for under AASB 15, the revenue standard. I'll now hand you over to Ben, who's going to take you through the timing of when revenue might be recognised if the contract is in the scope of AASB 15.
Thanks, Kim. So we've gone through and identified whether we have an enforceable contract, whether we have sufficiently specific performance obligations. We're now going to be focusing on step 5 of the revenue recognition model, which is whether or not you recognise revenue over time or at a point in time. And this is where we're seeing some practical issues come into play. So just a refresher on step 5 of the revenue recognition model. So under the revenue recognition model, there are 3 tests that apply in terms of determining whether or not a performance obligation is satisfied over time. Now, you only need to meet one of these 3 tests in order to have recognition of revenue over time. If you don't meet any of the 3 tests, then you recognise revenue at a point in time, which in some cases may mean that you end up deferring your revenue to a later point in time. So let's start with this first criteria. The first criteria or test is that a customer simultaneously receives and consumes the benefits as the entity performs. So the typical types of arrangements in relation to this would include routine or recurring services. So a not-for-profit may provide counselling services, for example. That will be one that would meet the first test. The second test that could apply is that a customer controls the asset as the entity creates or enhances it. So if we think about it from a transfer of an asset, you could be developing IP for a customer, intellectual property, and that intellectual property is controlled by the customer, and you could then meet the second criteria in order to recognise revenue over time. The third criteria is where an entity's performance doesn't create an asset for which the entity has an alternate use, and there's a right to payment for performance to date. So oftentimes we see where the other 2 criteria fail, that this is a criteria that entities look to. So for an example might be where you have a specific report or deliverable for a customer. However, within your contract there is a right to payment for performance to date, and that deliverable doesn't have any alternate use. So if you were to not meet any of the 3 criteria, you would then be recognising your revenue at a point in time rather than over time. So let's now go through an example just to illustrate some of these principles and think through them. So we have a research institute that receives a grant from Kids Health Foundation for $5 million. And the objective of this grant is to help improve stroke prevention for cardiac surgery for patients under 12. The grant's for 3 years. There is a refund obligation, so any unspent or amounts not spent in accordance with the agreement have to be returned. There is publication of research data on a website as it's obtained. So as the data is collected, it's actually made publicly available. The IP from research is neither transferred nor licensed to Kids Health Foundation, And if it's terminated by Kids Health Foundation, there's a right to payment for research completed to date. So let's just briefly touch on the analysis of enforceability and specific performance obligations. There is a return obligation in relation to the funds received, so that would mean that would be enforceable. In terms of the specific performance obligation, there is a specific performance obligation here to conduct research activities and to publish data on a public website. So under this situation, when would Research Institute recognise the revenue for their performance obligations? Well, the answer here is that revenue would meet the overtime criteria and be recognised as the foundation received the benefits of the research. So the key point here is that the foundation receives the benefit because there's the public research data being made available as the Research Institute collects the data. So if we were to go back to those 3 tests, it would be meeting the first test. However, let's change the fact pattern slightly to see if we end up with a different outcome. So the key change that we have here is that there is now a final report on findings received only at the end of 3 years. There isn't the public display of the data results on the website over time. Just ignore that last comment on no right to payment to date because there is a refund obligation. Kim, I know you've had a lot of experience with these queries from clients and others. How would you look at this situation?
Yeah, I'm happy to share some of the conversations that I've been having with clients in this space. In this particular example, we think the answer is that potentially the Research Institute would have to defer the revenue to when the final report is issued, given that we don't think they meet any of the 3 overtime criteria. Let me take you through the analysis. The arrangement does not meet criteria 1, as research data and findings are not being shared with the foundation or the broader community as it's being collected and analysed. It doesn't meet criteria 2, as there's no asset that's being created that is controlled by the foundation, as the IP embodied in the research stays with the Research Institute. And in relation to criteria 3, we assume that it does not meet criteria 3. Based on the facts we have, it's not clear if the research has an alternative use, and we're assuming that the nature of this research is reusable. And whilst there is a right to payment for performance to date, as spent funds do not need to be refunded, a reminder is that both the no alternate use and a right to payment need to be met in order to meet criteria 3 for overtime. So having indicated that, our preliminary view in this example is that revenue is not recognised over time, but at a point in time, and this is likely to be the point in time when the final report is issued. We do appreciate that this is probably not the best financial reporting outcome for entities in this sector. Therefore, we are continuing to work with clients in this sector and potentially with the Accounting Standards Board to come up with a conclusion on the issue. So the application of the new revenue and income guidance to research grants is definitely a watch this space. So, Ben, I might hand back to you to actually take us through another common issue in this area, which is the non-refundable upfront fee.
Thanks, Kim. Yeah, so for those who are schools or education institutions on the call, this is quite a common issue in relation to the treatment of upfront fees and in terms of when you need to recognise those fees. And the standard, which also applies to for-profits, gives us some specific guidance on the treatment of those fees that we thought would be worth going through. So the first question is in relation to an upfront fee that's received, is does it relate to specific goods or services transferred to customers? If it does relate to a specific good or services transferred, then you account for that promised good or service, recognise the consideration as revenue as you actually transfer that promised good or services. But in many cases, upfront fees may not relate to a specific good or service that's already been transferred to the customers. In that case, you account for those fees as advance payment for future goods or services, and then you'd recognise the revenue when the future goods or services are provided. But the question still remains, in terms of the fee, is over what period do you need to recognise those fees? Now, we do have a change with AASB 15 in that we have the introduction of a new concept called a material right, and this is a change to the current treatment. So a material right under AASB 15 is essentially a right to a discount on future goods or services that's given to a customer as a result of a current revenue transaction. We'll go through an example to illustrate this. So in this example, we have a private school, and it's requiring prospective students to pay enrolment fees. It pays it the year before they commence at school. In this case, we're saying the enrolment fee is a non-refundable fee. Could approximate maybe the prior year tuition fee of around $8,000. In addition to the enrolment fee for the first term, there's a tuition fee for the new year of $10,000, which is charged relating to education to be provided during that term. Important to note here, because it can change the outcome, is that the fee is not offsettable against future tuition fees. In this particular case, the student can leave the school with 3 months' notice. Similarly, the private school can give notice for 3 months. So it's a term-to-term contract. So how should this upfront fee, the enrolment fee, the first term tuition fee, how should it be accounted for? Well, the first key question is, does the fee, the enrolment fee, relate to any specific goods or services that have been transferred to the customer? Well, in this case, it's clear that the student hasn't started school in terms of when the enrolment fee is paid. So you can't start school without enrolling. Therefore, effectively, there's been no good or service transferred at the enrolment fee stage. There's no other benefit or good or service available. Another key question is whether or not you separately price and sell the initial right or activities covered by the upfront fee. If you think about it, any new student will have to pay the enrolment fee. So it's not sold separately, effectively, to your first term of tuition. So we've determined that we don't book that fee up front, but we book it over in a future period. But the question is, well, what period should we look to? Now, the defining question here is whether or not the non-refundable upfront fee provides the customer with a material right. And remember, we're talking about material right in terms of a discount for future services. So let's just look through the quantitative factors. So if you were to enroll for the first term, what would you need to pay? You need to pay your enrolment fee, effectively of $8,000 plus $10,000 for the first term. So you're paying $18,000 effectively for term one. What's that payment entitle you to? Well, apart from paying the first term's fees, in the future you won't need to repay the $8,000 enrolment fee. You only need to pay each term's fee. So it's effectively a 44% discount if you look at this in terms of your future contract periods, the future terms. So quantitatively it does look like it is quite material. However, you also need to consider qualitative factors. For example, the quality of tuition provided, inconvenience of changing schools. If on balance you think that that enrolment fee is giving you a material right, you then would need to recognise that discount that you've got, or the benefit of not being able to pay that $8,000 over the remaining of the school years. So not over the first term, but over how long you expect that student to stay at school. If the answer, however, was no, that it wasn't a material right, you'd recognise both the enrolment fee and the first term fee over the first term of $18,000. So we've covered off on the revenue standard implementation issues, but what about the impact in terms of the leases standard? So as a not-for-profit, you could have a peppercorn lease, which is quite common. A government entity or a donor might allow you to lease building or land for nominal consideration. But how do you account for it under the new not-for-profit standard? The objective of the new not-for-profit standard and the amendments to the leasing standard is intended to give some consistency in how leases are treated by not-for-profits. Let's have a look at how the new leases standard, AASB 16, interacts with AASB 1058. Well, the first thing is that not-for-profit entities should apply the guidance in 1058 at inception if the lease is at significantly below market terms and conditions to enable the entity to further its objectives. So a classic example would be a peppercorn lease received by a not-for-profit entity. When AASB 1058 applies, there's a requirement to measure the right-of-use asset at its fair value. The lease liability is then measured in accordance with AASB 16. That is at the present value of future lease payments and payments to the end of the lease, which for a peppercorn lease would be effectively its nominal amount, for example, $1. The right-of-use asset also, you need to consider any amounts recognised under different standards, for example, restoration, dismantlement costs. Any difference is recognised as revenue or income in the income statement, depending on or not whether the arrangement's a provision of a service or good under AASB 15 or 1058. So what's being done currently before we get to the new standard? Well, what we've seen in practice is there is divergence. Some 99-year Crown leases, for example, are shown on balance sheet with the lease asset recognised at fair value. Others will alternatively measure it at the nominal amount of the lease liability. Some below market leases are currently shown off balance sheet and either accounted for as gross up to income and lease expense or, in some cases, not accounted for at all. Let's look at some of the particular issues around the new lease standard. What if there are no lease payments? So you have an arrangement, but there is no payments required to be made. Can there actually be a lease? We understand that it's unusual for a contract to have no lease payments, as legally a contract would normally have to have a dollar amount payable, even though it's nominal. If there's no lease payments, then the entity should also consider whether there's payments in kind for the right to use the asset. For example, is the entity providing services in exchange for the right to use? Another consideration is around short-term leases. 1058 directs you to AASB 16 for the accounting for leases. Therefore, there is still that practical expedient which exists in 16 around excluding these short-term leases. Kim, given your focus on this area, I would appreciate any insights you have on recent developments in relation to this requirement.
Yeah, thanks, Ben. Like I alluded to at during my introduction to this webinar, there are some issues with regards to fair value in the right of use assets in a peppercorn lease. The good news, though, is that while there are significant issues, it's expected that the AASB will be providing not-for-profits with a reprieve from having to deal with it. Last week, the AASB agreed to provide an option to not-for-profit entities to defer the recognition of right-of-use assets at fair value. That is, when the new leases and revenue and income standards are effective in your 31 December 2019 or 30 June 2020 financial statements, then we expect that you will not have to apply this part of the new standard about valuing the fair value and the right of use assets. There are a couple of reasons for the deferral. The board considered that the financial reporting thresholds for not-for-profit private sector entities are likely to be revised as a result of the ACNC legislative review recommendations, and it is possible that entities at the lower end of the reporting thresholds might not be required to apply the requirements of AASB 16 and 1058 in the future. There's also just general acknowledgement of the interpretive issues arising from fair valuing such leases, and this would be better resolved as part of the broader fair value measurement project that the Australian Accounting Standards currently have. If agreed, and we do expect to proceed, the optional release is expected to remain in place until further guidance has been developed in this area. Entities choosing the temporary relief would likely value the right-of-use asset at the present value of the lease payment, which will be the nominal amount. I will now pass you back to Joe to take us through the interactions with the financial instrument standard.
Thanks, Kim. Not-for-profit entities need to also consider whether AASB 9 financial instruments is relevant when receiving cash or another financial instrument that is to be distributed to another entity or party. Two questions to consider when entering into these sort of transactions is whether the grant is received as cash or another financial instrument, and is the requirement of the agreement to pay out the amount as cash or another financial instrument, without providing any specific goods or services. Bearing this in mind, let's have a look at an example of the interaction between AASB 9 and AASB 1058. In this example, Regional Development Foundation has won a contract to administer a $10 million Regional Development Fund with the terms of the agreement as follows. They will receive $10 million upfront. The Foundation is required to distribute the $10 million to projects that meet the specific requirements in regional areas. The Foundation is required to identify projects, oversee the funding received and paid to projects, manage the day-to-day delivery of the projects, and provide quarterly financial information to the government of funds spent. If the agreement is breached, the Foundation is required to return any unspent monies to the government, and the Foundation is able to retain up to 3% of the fund to cover its costs in administering the fund. So based on this, how should the fund account for the contract? So in this example, the Foundation receives the cash from the government and has an obligation to distribute the cash received to various organisations, with any unspent monies being required to be refunded to the government. It is important to note that the Foundation is not providing any goods or services other than administering the fund, and accordingly, the cash received will be recorded as a financial liability until the monies have been spent. That is, the cash received is in the scope of AASB 9 financial instruments. In addition, the Foundation will also need to consider the administrative services provided and would record revenue of up to 3% of the cash received based on the cost incurred, and this is revenue under AASB 15 as it meets the sufficiently specific criteria in that the fund is providing an administration service to the government and there is a time frame for the provision of these services. I'll now pass you to Julie to take you through the transition and disclosures.
Thanks, Joe. Well, transitioning to a new standard can be challenging and in some cases quite costly. And the standard setters have therefore provided a number of options, including some generous relief for transitioning to these two new standards as well. So you can see on the slide an overview of the basis on which the amounts in your financial statements will be recognised depending on the transition approach that you adopt. Accounting standards always provide an option to apply the standard retrospectively, so that is as if the standard had always applied. And this is set out at the top line of the slide. You can see the basis of what your comparative period would be, as well as the first year of adoption. So a subset of the retrospective method, the partially retrospective method, gives an exemption so you don't need to consider contracts completed prior to the beginning of the comparative period or ones that began and expired in the same year. And this is set out in that second line on the slide. So more recently, with some of the new standards that have been issued that have significant impact, the standard setters have provided an option of applying the standard from what is called the date of initial application, which for 30 June reporters will be 1 July 2019 for these two standards. So if you are a 31 December reporter, it would be 1 January 2019. And this means that the standards are applied from this date going forward, and if there's any adjustment needed on contracts in existence at the date of initial application, that this adjustment is made to the retained earnings at that date. And this is termed the cumulative effect and is the third line on the slide. So under this option, as you can see, your comparatives will be as you recognised them last year under the old standards. The not-for-profit income standard does provide a significant concession in the practical experience that it does provide. And this is provided and able to be applied regardless of which transition approach you apply. And the experience is that assets acquired for significantly less than the fair value that were previously measured at cost on transition, but on transition they are not required to be remeasured to fair value. So disclosures is the last topic that I'm going to cover. And Kim, before I discuss a bit of the detail, you mentioned that you wanted to highlight the disclosures in the reporting period prior to implementation.
Yes, Julie, I did. I just wanted to remind participants on today's webinar that where you are preparing general purpose Tier 1 financial statements or you're preparing special purpose financial statements, then that we have an accounting standard that requires you to disclose the potential impact of standards that have been issued but not yet effective. That is, you will need to disclose the potential impacts of the new revenue and income standards in your 31 December 2018 or 30 June 2019 financial statements. So these are the ones prior to the effective date of the new standard. You have to disclose the potential impacts of the new revenue standards in these financial statements. If you're preparing general purpose Tier 2 financial statements, then this disclosure is not technically required. However, we do recommend that you think about making these disclosures, especially if the potential impacts will be material.
Thanks, Kim. So in terms of applying the new standards, there are two categories of disclosures that need to be thought about. Those are disclosures around transitioning to the new standard and also what we refer to as the business as usual or ongoing new disclosures. On transition, both qualitative information about the key changes in accounting policies is needed and also a quantitative reconciliation of adjustments made in applying the new standard. And these are the typical type of requirements where there is a change in accounting policy. If you elected the cumulative transition approach that I just spoke about, that third option, the new standards require you to disclose in the notes what the current year amounts would have been if the old standards had continued to be applied, and also an explanation of the reasons for any significant changes identified. So this will provide comparability for the users of your financial statements, but may mean that you need to calculate the numbers twice. So not only the new way under the new standards, but also how you would have done so last year under the old standards. So that might be quite a burden for you and something that you need to think about now. So you can see in front of you the areas of disclosure required by the new revenue standard, that's AASB 15. They are quite extensive and cover quite a number of areas, and you'll need to consider where you have transactions that fall within the requirements of the revenue standard. You'll need to consider the disclosures relevant to them. So we haven't spoken about all of the areas that are set out on the slide, and some of our other revenue webinars have gone into them in more detail, so we invite you to listen to those again. But the detail can also be found in the standard, and we also have illustrative disclosure publications which provide examples of how you might disclose the details that are actually required. As many not-for-profit entities will be preparing general purpose Tier 2 financial statements, you'll be pleased to know that some of the detailed disclosures are reduced under this regime. However, all of the aspects at a high level that are mentioned on this slide, such as performance obligations or significant judgments and the like, are still required to be covered by the reduced disclosure requirements. So similar to the revenue standard, the not-for-profit income standard also has enhanced disclosures around income, specifically covering the areas, again, that are set out in front of you at the moment. Really the key in terms of considering what to disclose is to refer to the disclosure objective of the standard and to include information as guided by the supporting disclosure paragraphs that help your users of the financial statements to understand the effects of the transactions where you acquired an asset for below market consideration, principally to enable you to further your objectives. Helpfully also, there is actually one topic that the not-for-profit income standard does actually provide an illustrative example for, and that is in relation to restrictions on the use of any resources. You may want to refer to that if you have similar types of transactions. So with that, I'll pass you back to Kim to wrap things up.
Okay, thank you for that, Julie. Okay, so as you implement the new revenue and not-for-profit income standards, we do have some questions for you as you go. Does guidance in the not-for-profit income standard or the revenue from contract with customers standard apply to your transactions? This is likely to be yes. Do you fully understand the facts and circumstances of these arrangements? Do you have all the relevant documents and information needed to determine which standard to apply and how to apply those standards? Have you determined whether the performance obligations are sufficiently specific and whether they are likely to be met over time or at a point in time? And which transition approach are you thinking about taking, and have you considered what would need to be disclosed in the years before the standards are effective and when they are effective? And the other thing, not on this slide, but is to, as per usual, is just keep an eye out for evolving interpretations in this area, especially in the areas that we've identified as a watch this space.